So let's continue. So I got distracted by highlighting. No, not in a bad way. She eventually explained to me the logic behind the highlighting, and it actually does make sense. Okay, but just as a side note, in terms of highlighting your legislation, please avoid the highlighting the entire sentence, because what's the point? Okay, highlighting is about highlighting what is important out of that sentence. Okay, so always try and make sure that you don't highlight everything. What I do personally is, if you look at my legislation, it's highlighted in a way that I can read that sentence as a proper sentence from the things that I've highlighted. There's obviously additional things in how legislation is written that I'm going to say is not necessary, if I can call it that, to form a proper sentence. Okay. But for me, in order for it to make sense in my head, I would highlight the words that make up that sentence, that ultimately I read it and I say, okay, the highlighted parts, this is what it means, and life goes on. But we all think differently, so I can't, it's not like I'm imposing my way of highlighting. It's just, people that just highlight the entire thing, and you see the entire page is blue, and it's like, what's the point? Okay, because then you are, as it says, you are highlighting. So what's important? Right, did I answer your question? I did, eh? Okay.
Oh no, I actually answered myself.
You answered yourself, okay.
No, in my head. I was going to ask again, it's fine.
No, you can ask.
So I was going to ask in that example we're doing, if I buy a property for 1.25 million, so it will be the 1.25 less the 750.
Yeah, multiply by 3%. Okay, so the question she's asking relates to transfer duty. So in terms of how you charge transfer duty, so anything below 750,000 rands, it's at 0%. Between 750,000 and 1.25 is 3%. Between 1.25 and how much? 1.75 is 6%. And I think from 1.75 to 10 million.
No, it goes to 2.2.
Okay, so to 2.25, that's what, 9? 8. Then from 2.2 to 10 million is 11%. So she was asking, what do you do? Do you take for example, in our example of 1 million, do you simply take the 1 million and charge it at 3%, or do you say 1 million minus 750 at 3%? Okay, so it says 3% of the amount as exceeds 750. So you need to take the difference between the million and the 750, and then multiply that by 3%. Okay. Right, so now we move on to going concern. Something that gives you nightmares. All right, please note, when you are looking at going concern, it does speak to something else in the Income Tax Act. Which piece of legislation or which section of the Income Tax Act talks to the buying and selling of businesses? Buying and selling of businesses. Corporate rules? Corporate rules. Okay, when you're thinking corporate rules, you need to be thinking about this as well. So you can get an income tax question on corporate rules. It can go with this. Okay, now, something else that you need to be thinking about whenever there's a sale of a business, all right? Remember, going concern is dealt with under Section 11E. Okay? But then you've got another section in the VAT Act that deals about the buying and selling of businesses, which is what? Which links to corporate rules. What's the VAT section that directly links to corporate rules in the VAT Act? Section 8? I've narrowed it down, so you need to give me a subsection under Section 8. Section 8, subsection... this guy, no. Okay, I'm going to narrow it down from, thank you very much, Section 8, subsection 25. That talks directly to corporate rules. Okay, so whenever you're seeing corporate rules, you are seeing going concern, you need to be thinking about three things. Section 11E, Section 8, subsection 25, corporate rules in the Income Tax Act. Okay, now in the VAT Act, you need to make a decision. Am I going for 11E or am I going for 825? Okay, seeing that we're all blank and you're at 825, you can do us the pleasure of reading 825. Anyone? Go for it. No one's going to bite you if you read it. Or I can volunteer you. So 825. Anyone, guys? Hey? Okay, read what it says.
Where any goods or service are supplied by a vendor to another vendor, those vendors must, for the purpose of the supply or subsequent supplies of the goods or services, be deemed to be one and the same person.
Okay, and?
Provided that the provision of section 42, 44, 45, or 47 of the Income Tax Act are complied with. So many provided.
Ah. Is that what's going to happen in the exam? Too many provided.
Provided that this taxation shall not apply to a supply contemplated in section 42 or 47 of the Income Tax Act.
Okay.
Unless that supply of an enterprise or part of an enterprise which is capable of separate operation, where the supplier and the recipient have agreed in writing that such enterprise or part, as the case may be, is disposed of as a going concern.
There we go. All right, so 825 should be your first point where you start. Because 825 says, if there is a transaction, and that transaction is between, it's a section 42 or a section 45 or a section 47, okay? That transaction is looked at as if you are selling to yourself, and therefore there should not be any VAT implications. Okay, so that's what 825 is saying. Okay, it's 42, 45, 47. You are looked at as if you are selling to yourself, so effectively you cannot have a transaction with yourself. Hence, there are no VAT implications when there is a 42, a 45, or a 47. Okay, but obviously you need to justify why there are no VAT implications. Okay, but it then says, unless you have chosen to go for section 11E. And section 11E is then going concern. Okay, so you can get out of using section 825 by going to section 11E. Right, so we might have a transaction that is under section 42, an asset for share transaction, where you are buying a business and that business is being bought as a going concern, right? And both parties have an agreement that say we are buying or we are, this transaction that we've entered into is the sale of a going concern. But remember 825 says they have a choice to go for 11E. Okay, if you read from unless, read from unless. So where you started.
Unless that supply is of an enterprise or part of an enterprise which is capable of separate operation, where the supplier and the recipient have agreed in.
Okay, wait there. Okay, as you can see, the supplier and the recipient of those goods have to agree. So it is not automatic. So it will not automatically go out of 825. They have to agree. So in your exam, you need to be looking for something that says the buyer and the seller have agreed to move out of 825 and they've gone into section 11E. Okay, if the question is silent and you feel more confident of 11E than 825, you write, I assume they have agreed, therefore I am moving to 11E. Okay, but if it is not written out very clearly, chances are they've put something in the question paper that gives you guidance. Okay, because that question is allowing you to select. If they put it in the question paper and they do not make it clear of what selection has been made, they are making a headache for the person who's marking, because students are going to go in different directions. Okay, so something like that is something that would be looked at when a paper is being set to make sure that students do not go in different directions. Okay, so there will be something in the exam paper that gives an indication of whether you should stick with 825 or you should go to 11E. Okay, so always remember that there's that interaction between 825, 11E, and 42, 45, and 47 in the Income Tax Act. Okay, so just always remember that whenever you're seeing going concern or there's a section 42, 45, 47 transaction under corporate rules, you need to be thinking of 11E, 825 and make a decision between the two in terms of which one you'll go for. Okay, so now let's go to section 11E, which is the sale of a going concern. Right now, in a sale of a going concern, and over here, the first scenario that we're looking at a scenario where the supplies that are being made, it's 100% taxable supplies. Okay, so the person who is selling is making 100% taxable supplies. Okay, then that person who is selling is going to levy VAT output at 0%. So the sale of a going concern in terms of section 11E, remember section 11 is zero-rated supplies. Okay, so because it's under section 11, it means there is zero-rated implications. Okay, so the seller, when they're making that supply, they charge VAT at 0%, which means for output, VAT is going to be nil. And then for the person who is buying, because they are buying a going concern, the output, the input that they will claim is at a percentage of 0%. Okay, so no output and no input. Okay, but it makes sense. What you're simply doing, because you're selling a going concern, you are taking the exact same business from one person and you're giving that exact same business to somebody else. Okay, hence they're then saying there shouldn't be any VAT implications because they're now viewing the persons as the same person. Okay, when that transaction happens. Hence, there are VAT implications, it's just that the VAT implications are at 0%. Okay. Now, this is the easier one. The second one that we look at is, again, it's the sale of a going concern, but you're not making 100% taxable supplies, but your taxable supplies exceed 50%. Okay, so you're not making 100% taxable supplies, but your taxable supplies exceed 100%. Now, let's first look at the seller. Let's make an assumption that this person Okay, so we've got a supplier who's selling a going concern. So this person is making taxable supplies of 60% and non-taxable supplies of 40%. Right, so what this is saying is that you are going to charge output at 0%. But remember, you do not apportion output, except for when? When do you apportion output? Indemnity payments and adjustments. This guy. Like the more I'm asking you, the more your volume is going down. What adjustments? Okay, so section 18 is the other one where you apportion for output. There's the last one. Last instance where you apportion for output. Fringe benefits. Okay, if you making fringe benefits to employees, you're allowed to apportion for output. It's only those 3 instances that you're allowed to apportion for output. Other than that, you are never, ever, 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 ever allowed to apportion for output. Okay, so fringe benefits, section 18, and indemnity payments. Other than those 3 instances, you are not allowed to apportion for output. Okay, the reason why I'm explaining this is because now this person is selling a going concern. They're only making 60% taxable supplies. Okay, so they're not going to apportion for output. So when they're making this sale of a going concern, let's say this business is being sold for 100 million. Let's put numbers to it. Okay, so it's being sold for 100 million. Now we need to account for VAT. We're looking from the seller's perspective. Okay, because output is not apportioned, what's going to happen is that this output is going to be based on 100 million at 0%. Okay, which it gives you 0 rands, but the important principle that you need to remember is that VAT has been charged on the entire supply. You agree with that? VAT has been charged on the entire supply. It's just that VAT was charged at 0% and ultimately it gives you 0 rands. But VAT has been charged. So this person has had to account for output. But think before this transaction, what would have been happening in terms of the input that this person was claiming? Okay, the input this person would have been claiming is to the extent of the taxable supplies. Now, can you see there's a bit of an imbalance that has happened? Okay, because remember, VAT is all about balance. Okay, when there's 100% this side, there needs to be 100% on this side. So if input is at 100%, output must be at 100%. If output is at 100%, input must also be at 100%. So now there's a bit of a mismatch, and that input for this person is at 60%, and output is at 100%. Okay, now what we need to do, we need to make sure that we take this input that this person has been claiming and we push it up to 100% as well. Okay, so what do we do? Under 16.3H, this person is now entitled to an additional input. Okay, because they have previously claimed their input at 60%, but the going concern, they are selling it at 100%. So now they are now entitled to an additional input to match the 100% output. So now they're going to get an additional 40% of input. Okay, so and how do we calculate that 40% additional input? So A would then be the tax fraction. So tax fraction being 14/114. And then C will then be the lesser of the adjusted cost, all right, or the market value if it's connected persons. All right, or it will be the open market value of when there was a change. So let's say there was a sale of a going concern before this. Okay, there would have been a change in the open market value before then. Okay, or the open market value on the current date of the change in usage. Because remember, what we've effectively done over here is that we've moved the supplies from 60% taxable supplies to 100% through the sale of a going concern. Okay, hence it's talking about a change in use. Okay. Doesn't make sense. Okay, but anyway. Okay, so what you're doing over here, we're then saying of this value, we need to get back that 40%. So this person will claim an additional input of that 40%. So we're comfortable with that. Okay, previously your input you were claiming at 60%. You're making a supply of a going concern, but you make it on 100%. So your output is at 100%, but your input is at 60%. So there's a mismatch. And therefore, we're going to give you an additional input to make sure that your input goes back to 100%. So you're going to get that additional 40% as an input tax adjustment. Okay. Right, and then in an instance, okay, so this is just a bit of a, sorry, I actually skipped this part at the bottom, okay, because 100% taxable supplies are being made to the buyer, so on the buyer's perspective, they're going to claim input on 100% of the taxable supplies. Okay, which means then on that entire supply there's going to be nil input.
So to take it back a bit, you said a portion for fringe benefit, indemnity, and the third one is?
If you're looking at section 18.
Oh, section 18.
Okay, so we're comfortable that the buyer is going to claim 100% at no value, right? But in an instance where the buyer is not going to supply those goods at 100%. So going forward, so he buys a going concern, all right, but he is also going to make taxable supplies of 60%, all right? but he's claimed his input at 100%, but going forward, he's going to make output at 60%. Right. Now, what needs to happen there, because we need to balance the scales, okay, our input is sitting at 100, output is sitting at 60, which means we need to push up his output to 100 as well. So what will then happen is input is accounted for at nil, but then he must make an adjustment of output under section 18 cap A of additional output. Those faces. Talk to me, guys. Your faces are talking to me. Sorry, you were saying so?
This is the other way around of the other one.
Yes. So over here, we're looking at an instance where it is the seller. So the seller, their output is at 100%, but their input is at 60%. So we make an additional adjustment of input. But for the buyer, their input is at 100%, but their output going forward is going to be at 60%. Because remember, you are buying the exact same business. So let's say if this business on the one hand is making, what makes it easy? Okay, let's say we're selling furniture. We use Steinhoff. Okay, we are Steinhoff. We are selling furniture and clothes via Pepco and all of those places. So this is our taxable supplies business. And then on the other hand, we run a financial services business where we're providing store cards, we provide credit to somebody who wants to come and buy furniture and all of that. Okay, so that is financial services, hence this part is exempt and this part is taxable. So now if you go and buy Steinhoff, you are going to go and buy Steinhoff in its entirety. That's the case. Okay, but what's going to happen once you've bought this business, you're going to continue doing this. You're going to continue supplying furniture, which is going to be at 60%, and you're going to continue with the financial services business, which is going to be at 40%. So hence I am saying, when you bought this business, they said to you, you're going to claim input, and that input you claimed on the entire business because it was sold to you as a going concern. So you claimed input on the 100 million. Ignore the fact that the rent amount comes to zero. But there is VAT that you've claimed. It's just that that VAT you've claimed at 0%. Okay, so hence I am saying your VAT input as the buyer is sitting at 100%. So it's saying you are making 100% taxable supplies. But your output going forward will only be on this portion, which is the sale of the furniture. Hence, I'm saying there's a mismatch. And that is why you then have an additional output, all right, relating to this portion that you've claimed.
Does the taxable supplies have to be the same percentage as how the previous company?
No, it does not have to be. Okay, as long as it is not 100% taxable supplies, you will have that adjustment. Okay, let's say 95%, because then 95 to 100 is assumed as taxable supplies. So as long as your taxable supplies do not exceed 95%, then you will have this adjustment of additional output. Okay, because think about it. If you go and buy, now you've bought an entire business that has got machinery and all sorts of things already set up. Okay, hence there's no need for you to do the apportioning. But imagine this, if you went and bought a couch making machinery under normal circumstances, you would claim input, and because it is 100% related to the furniture making business, you claim 100% input. But if you go and purchase computers to be used in the financial services side of the business, you would never get that input because it relates to an exempt supply. But now, because you've bought the entire business, we cannot make a distinction between what part of the things that you've bought relate to this side and what part of the things that you've bought relate to this side. Hence, the easiest thing to do is to treat the entire thing as taxable supplies. Okay, but because we recognize that going forward, it's the only way where we can determine what is taxable and what is exempt. Hence, we then use that to make a separation of the additional output that needs to be accounted for. Okay, we are comfortable. Silence does not make me comfortable.
Okay, I have a question. What if this was a discussion question? How do I answer this?
So what if this was a discussion question? Okay, let's say they don't specify to you who of the people you must discuss. They just give you this and say VAT implications, which means you need to discuss this from both the buyer and the seller's perspective. Okay, you'd have to start with the seller and say for the seller, the normal things, it's in the furtherance of an enterprise. And actually, if you look at the definition of an enterprise, it does talk about the sale of a going concern. Okay, that it's part of a, I think it's in supply or enterprise, I can't remember exactly. Okay, that it does form part of the furtherance of an enterprise. If you are selling a going concern, okay, you start thinking about things like timing and all of that. Okay, you then have to go into section 825, okay, in terms of the deemed supplies, and say that, so the question would probably have said that both parties have agreed that this is a sale of a going concern. Okay, so you'll talk about section 825, that we were not going to apply 825 because both parties have agreed that this is a sale of a going concern, and therefore I'm going to apply the provisions of section 11E of the VAT Act. All right, and then under section 11E of the VAT Act, the implications now for the seller would be VAT is charged on the supply, and obviously we'll discuss what's the value of the supply in terms of section 10, okay, and then the timing of the transaction as well under section 9, and then but at a rate of 0%. Okay, if numbers are given to you in that question, okay, they are not there for decoration purposes, please use them to support your argument. Okay, I know the answer that you're going to get to is 0 rands, but you need to say the consideration of 100 million multiplied by a rate of 0% equals to 0 rands. There is a mark allocated to that. Okay, because you need to use the numbers to support your argument.
Okay, and another question. With section 16.3H, so...
We'll get to 3H. Let's finish first with 11E.
Okay.
Okay. Okay, ask and then I'll maybe ask
I
them.
want you to ask the part where they always say there's a mismatch. So if I just say there's a mismatch, I get a mark.
Yeah.
Yeah, because I've seen in the solutions there is a mark.
Yeah.
I never... Okay, it doesn't click when I'm in the exam.
But suppose you need to find your own words of explaining it. So Eva was drafting that solution that they thought mismatch is appropriate, which it is appropriate. There is a mismatch because you've charged VAT on 100% taxable supplies, but previously you were claiming input on 60%. Okay, hence now you must claim the additional 40%. Okay, and numbers will be given to you, and therefore you're going to use that to get to your 40% of additional input.
Okay, the reason why I'm asking is just because we might use our own words thinking that I've nailed it and then...
No, you can use your own words as long as you are comfortable that those words are saying what's in the legislation.
Yes, I'll think maybe I'll be comfortable with it. But then when I get my paper back, oh, they don't even mark it. So what I'm trying to say is, do I have to actually write as the same way they do in the solution? Because I've seen
No.
mismatch. When they 16.3H, I've seen mismatch. And then you get it back.
Look,
Then I'm trying to write a long sentence, just trying to explain mismatch.
you know what's the nice thing about tax? There is no wrong answer in tax. I promise you, yes, there's no wrong answer in tax. It's interpretation. Tax is about interpretation. Now, you need to interpret what's in front of you, and you need to put it in your own words. So if you feel the word mismatch captures what you're trying to say, then it is a mismatch. But now you can't use mismatch by itself. It needs to be a mismatch. What they'll probably highlight and make in bold will be the word mismatch. But you must remember that mismatch forms part of a sentence. So there is a mismatch in terms of the input that was previously claimed compared to the output that you are accounting for now. And therefore, you need to account for the additional input in order for you to have VAT accounted for on 100% taxable supplies.
Okay, so in other words, you're trying to say that it has to make sense.
Yes. Yes, it has to make sense.
Okay.
Just like in auditing, when you're writing, you need to make sure that you've answered your why and your what and your how and all of that. When you're writing in text, you need to answer those same questions. Okay, there are plenty of times I've marked somebody's solution. I can see that the person understands, but I read a sentence and after the sentence I write why. Okay, remember the question says to you, discuss the text implications. Okay, you cannot simply jump into it. Imagine this, you are offering advice to somebody else. You cannot simply say to someone, you're going to have capital gains tax implications of 100,000 rands. The question is why? Why do I have those tax implications? Okay, so just like in auditing, they hammer it in your heads that you need to answer the what, the when, the how, and all of that. When you're writing a discussion question in tax, you are providing advice to child in grade 1, and they need to understand thoroughly what you are saying. Okay, I always say when you are writing, okay, you need to be singing to yourself as a mantra at the back of your head as a reminder that the marker is dumb. Okay, so as you're writing, you need to be saying the marker is dumb, the marker is dumb, the marker is dumb, the marker is dumb, the marker is dumb. Okay, the reason why you need to do that is so that you can explain this to a person that is dumb. Okay, regardless of the fact that that marker has lots of experience in tax, I promise you when they're marking, they will act dumb. Because they'll read your sentence and write why and move on. Okay, they will read your sentence and say, how do you determine this value? You cannot just throw 100,000 rands at me. How did you get there? Okay, this is a supply. What is the supply? Okay. Unfortunately, and that comes with practice, where when you're writing, you need to be reading your sentences and making sure that you've answered, okay, have I answered the why, have I answered the what, have I answered the how? Because sometimes you know what you're doing. You're throwing 100,000 rands at me, and I know that's correct. I read it, and I'm like, this person knows what they're doing. But unfortunately, they're not explaining it to me. So I'm going to give you a mark for 100,000 rands. You're going to lose the other 5 marks of explaining how you get to that 100,000 rands. Okay.
Yeah.
All right. So we were on the seller. So we went to, so we've accounted for output under 11E, and then we go to section 13.3, where we then do the matching of the output of the input to the output. All right. Then the next part is then to say what are the tax implications for the buyer. Okay, I've previously seen a question like this, and a nice solution was set out in a way that they first discussed the general provisions at the top, so in terms of the supply, the enterprise, and all of that, because those things are equally applicable to the buyer and the seller. Okay, and they spoke about section 825. 825 is equally applicable to the buyer and the seller. Then after discussing the general provisions, they then went into separate solutions for implications for the seller, implications for the buyer. Okay. In that way, you're saving time, because the general things, you do not have to repeat them when you go to the buyer. Okay. Okay. So now we then need to go and calculate what is now this 40% adjustment that you're going to do. So the first thing we do is, what's the value of the going concern? In our example, the value of the going concern is 100 million. Okay. From this value of the going concern, we then need to strip out certain things. The first thing that we're going to strip out is goods that will be, or assets that will specifically relate to the 100% taxable supplies. So we need to look at this part of the business and say, of this 100 million, what part of it is represented by assets that are sitting on this side? Okay, then we'll then minus those assets from this 100 million. So let's say it's 60%. I'm going to make this, no, I'm not going to use the percentages because it's going to confuse all of us. So let's say the assets sitting over here are 70 million, and we've got assets this side of 30 million. Okay, so what to do from this, we're going to strip out that 70 million. Okay, because that is at 100% taxable supplies. So that means when these assets were bought, we would have claimed input on the full 70 million because they specifically relate to taxable supplies. Okay, hence we need to strip them out. So we are then left with this 30, which relates to the exempt business. Okay? Then you must then reduce by assets for which input VAT would have been denied. Okay. Now we're looking on this side. So now we're looking on this side and we're saying, do we have assets on this side where if this was a taxable supply, if this part of the business was taxable supplies, we would not have been able to claim input anyway. So the example that's given there is a motor car. So if we had a motor car this side, regardless of the fact that this was taxable supply, we would still not be able to claim input. So hence we must take it out because by putting that in, we effectively now inflating our input because then would not, in normal circumstances, we would not be able to claim input on that. So let's say we've got vehicles this side of 5 million, so we'll strip that out. Okay, so that would be that. So that's 130, that we're left with 25 million. Okay, so over here, these are things that we can see. We can easily see and say this belongs to that side of the business. Okay, but there are certain things that we use across both businesses. Let's say, as an example, this business is run as one business, so it's not separate divisions, and we've got the CEO of the company. And the CEO of the company is using a laptop. So let's say he's got a MacBook and we paid 30,000 rands for that MacBook. Right. Can we actually identify and say this MacBook is used on this side of the business or on that side of the business? We can't, because he's the CEO of the entire business. So the only other thing that we have is to look at these percentages and assume that the MacBook is used 60% for this side and 40% for that side. Okay, so hence, if you are sitting with this 25 million, over here, you'll still go on further, which is this step here, and reduce it by the non-taxable, or sorry, multiply it by the non-taxable portion of the business. Okay, because even when we get to this 25, we are still not sure if there are things that belong to this side of the business. But if it is very clear that there is nothing left in this 25 million that belongs to this side of the business, then what you'll simply do is to take the 25 and multiply it by 14%. But in an instance where we are still not sure whether the assets that are used across between the two businesses, what we'll do, we'll take the 25 million and multiply that by 40%. Okay, and then multiply that by 14% to get what is the amount of VAT. Okay, we comfortable?
So that they will tell us the 60/40.
Yes. Or not. Depends. Okay, if they're nice, they'll tell it, they'll give it to you. If they're not nice, they might give you the 10 over numbers, and you then have to use the 10 over method to determine what is taxable supplies and what is exempt supplies. Okay, we can move on from this. So we're comfortable. So in an instance where it's more than 50% taxable supplies, but not 100%, you have output at 0. You have addition. You have output at 0. You have additional input for the seller, and then for the buyer, it's input at 0 and additional output if they are going to continue using them for a portion which is non-taxable supplies. Okay. Then the last part that we then look at is the sale of a going concern, but then the taxable supplies are less than 50%. So in this instance, this is the other instance where you're allowed to then apportion for VAT. Right? So when we're looking at the seller, so the seller will charge 14% on the non-going concern sale, and they will charge 0% on the going concern part of the business. Okay, guys, comfortable with that? That one, straightforward, you know. Person is making 40% taxable supplies and 60% non-taxable supplies. You charge 0% on 40%. You charge 0% on the non-taxable. Okay. Serves me right for using the same example. Okay, let's use an example of 30% so that we don't get confused, and non-taxable of 70%. All right? So it's saying on the non-going concern part of the business, you're going to charge 14%. On the going concern part of the business, you're going to charge 0%. Okay, as the seller. Then over and above that, he's now going to have an adjustment, okay? So there's going to be an input VAT adjustment on the portion that was previously not claimed. Because remember, can you see what's happening here? We've charged VAT on 100% of the business, but there's 70% where it's non-taxable. So now there's an addition, so we're out of sync. This person has previously been claiming VAT on 30%, but output is sitting at 100%. So now we need to push up that output to 100% as well. So on this part of the business, which is the 70%, he's going to have a Section 16(3)(h) adjustment. Okay, to bring him up to speed. And then, in terms of the purchaser, so the purchaser will claim input, which is then paid on this 14%. Okay, and also to the extent that they will be making taxable supplies. And over and above that, all right, because they've bought the same business, they're going to have an adjustment now for additional output. Because their input is based on 100%, but they're going to continue making 30% taxable supplies. Now we need to push the output to 100%. Okay, so the balance needs to happen. So you always need to look at VAT and make sure that the scales are balancing. If output is at 100, input must go back to 100 as well. If input is adjusted to 100, output must also be adjusted to 100. Okay, we can move on. No, yes. Silence is not comforting. All right. Okay, we've spoken about zero-rated supplies, exempt supplies, deemed supplies. We've spoken about this. Fringe benefits and payments exceeding consideration. Okay, quickly touch on this in terms of payments that exceed consideration. Right. Here you're going to have a deemed supply if, as an example, you've got a debtor and that debtor pays you, let's say that debtor owes you 100,000 rands, but that debtor in error pays you 150,000 rands. And you decide, I'm going to sit with this person's money and not pay it back to them. Okay. If that is the case and you have not refunded that amount within 4 months from the date that you received it, you'll be deemed to have made a supply of that additional 50,000 rands. Okay, so it's just something to always watch out for. They can give you a debtor's, a debtor's aging, and it will show that this person is sitting with a credit balance, and that credit balance is sitting at how many days? What would be 4 months? 90 days is 3 months, so 120. So you might find somebody who's sitting with a debit balance, sorry, a credit balance in your debtor's age analysis. Okay, no one's going to tell you that there's VAT there. Okay, you need to be able to identify that this person is sitting on 120 days, therefore there's output that needs to be accounted for. Okay, similarly, it's not on the slides. In an instance where you do not settle your creditors within 12 months, okay, there is a deemed output after the end of the 12th month. So if you do not settle your creditors, so you are given 12 months for purposes of VAT, you are given 12 months to settle your creditors. If you do not settle your creditors within 12 months, the amount that remains outstanding you will be deemed to have made a supply of that amount, which makes sense. You can imagine how I can fund my business by simply buying goods and refusing to pay people. And what I'll then do is to claim the input, of course, when I purchase those goods, but I never pay for those goods. So I am running a business that is being funded by other people because I never pay for those goods. So hence, SARS gives you 12 months to settle whatever you owe to other people. If you do not settle what you owe to other people, they're reversing out the input, basically. Okay, it's just that because it's a different period, you have to account for it as output. For how long will they keep on charging? No, it's a once-off. Yeah, so it's a once-off thing that happens. So after the end of the 12th month, okay, immediately there's a deemed output of that amount that remains outstanding. So it's not the entire balance, it's the amount that remains outstanding. Okay, so there'll then be a deemed output on that. So it's things like that that in a question possibly will not be said to you. You can get a creditor's age analysis that shows somebody sitting at more than a year. You need to know that, boom, deemed output. Okay, debtor's age analysis, somebody sitting at 120 days and more, boom, there needs to be VAT on that amount. Okay. There's a?
The debtor's age analysis, is it after 90 days?
120, so it's 4 months. So it's 4 months, which is 120 days. Well, 120, depending on who's setting, you look at the actual months and 4 months of those. Yeah. So I think at most it will probably be 125 days, depending on the months that you're looking at. Okay. One thing before I forget it, because it's a common mistake again that you see. Whenever you need to reverse input, okay, it depends on when you are reversing that input. Okay. Let's say, as an example, in the current month, I bought goods and I'm going to claim input of 100,000 rands. But just before the end of this month, that same month, before I submit my VAT 201, I then realize that I've made a mistake with that 100,000 rands. It should not be 100,000 rands, VAT input I'm claiming. It should be 70,000 rands, VAT input I'm claiming. So there's a 30,000 adjustment that needs to be made. Okay. Because it's within the same VAT period, you are allowed to adjust the input because it's within the same VAT period. And the reason why I'm saying you're allowed to adjust the input, it's because, remember, ultimately, you're going to submit a VAT 201 form. And in your VAT 201 form, you can't show SARS that, oh, by the way, I made a mistake, and therefore there's 100,000 rands, and I'm making an adjustment of 30 to get to this amount. Okay, so hence, within that VAT 201, you can make the adjustment yourself, okay, without making SARS aware. But, not a problem, but the challenge comes in when in the one VAT period, you've accounted for VAT of 100,000 rands as an input, so you've claimed 100,000 rands. But in another period, you then realize that, oh, I made a mistake. Instead of claiming 100,000 rands, I should have claimed 70,000 rands. Okay. Now, because you are in another VAT period, you cannot have a negative input. Okay, you can't go into the VAT 201 form and say, minus 30,000, okay, to show the reversal of the prior year. So the only other way you can do it is to actually declare output. Okay, so you'll declare an additional output of 30,000 rands, okay, in order for you to make us aware that I made a mistake in a previous VAT period. Okay, I know a lot of students tend to get confused by that, and they ask themselves, but now what do I do? Because in a theory question, you need to say that I'm going to account for additional output. You cannot say I'm going to adjust input, because this is something that is happening in a different VAT period. And you cannot then adjust input in a different VAT period. You need to account for additional output. Okay, that's section 18 will then kick in when you're accounting for that additional output. And then if you are maybe claiming additional input, you're then going to use section 3H to make that input adjustment. Okay. Comfy. I want to go to I think you should be comfortable with this entertainment. I'm cool with that. Right, just in terms of the admin of VAT. So very quickly in terms of the timing of the supply, okay? And this has been specifically put under admin because timing talks to that. So again, it's the area of the date of the invoice and of the payment. And remember that affects what? It affects the 201 that you're going to submit. So which VAT 201 will that transaction fall into? Which you then need to address as part of your solution. So you'd say your timing is the area of invoice or payment, but also looking at the 201 that you are looking at. All right. And then installment credit agreements, which is now the special rules. Okay, so we've been discussing the general things around VAT. So if you get to the special rules. So if you're dealing with installment credit agreements, remember with installment credit agreements, you've got two types. What are the two types of installment credit agreements? You guys come across the definition of installment credit agreement? Yes. Okay, you've got paragraph A and paragraph B. Okay, paragraph A talks about a buyer and a seller. And in that transaction, interest has been charged. And the total value of the payments exceed the total value of the goods that have been sold. Does that sound familiar? Silence is not comforting. Okay. And then part B talks about a lessee and a lessor. And it then says that asset is leased for a certain period and interest is charged on that transaction and the payments of the lease term exceed the value of the goods that have been supplied. Okay, so the important thing with installment credit agreements is that there is interest that is charged on the payments that are made and it is over a period of time. So settlement of that is over a period of time. So if you look at paragraph A, the example I can use is if you go and buy a car. Okay, the transaction that you enter into with the bank is an installment credit agreement. Okay, you become a buyer and the bank becomes a seller. They charge you interest, you pay them over a 5-year period, and if you look at your payments that you've made to them compared to the value of your car, the payments that you're making to them exceed the value of your car. Okay. Something else you can do is you enter into a lease agreement with Avis. Let's say you enter into a lease agreement with Avis Fleet. So Avis Fleet says to you, we're going to give you this car for a period of 3 years. Okay, you're going to pay us on a monthly basis 5,000 rands. And after 3 years, you're going to give us our car and you can walk away. Okay, so that's a form of an installment credit agreement, but that is paragraph B, installment credit agreement. So paragraph A, you are a buyer and the other person is a seller, which means there is a change of ownership. In paragraph B, you are a lessee, the other person is a lessor, but there is no change of ownership. Okay. Common mistake that is made by a lot of students, because we are accountants, we start thinking about IFRS and we want to put installment credit agreements in the box that is the definition of a finance lease and an operating lease in terms of IFRS. Okay. For tax purposes, there is no such thing that is called a finance lease. There is what we call an installment credit agreement. The only thing that you can try and maybe say is similar to a finance lease for accounting purposes is the definition under paragraph B of the installment credit agreement. Okay. But it does not have the requirements that you need under IFRS to classify something as a finance lease. Okay. In a tax paper, you might get a question that talks about an installment credit agreement finance lease. They're talking about paragraph B, if you see that. Okay. But in tax, an operating lease, so in tax you've got installment credit agreement, which has a finance lease. And again, I'm saying it in inverted commas, finance lease, which is paragraph B. Right? You then have an operating lease, and an operating lease in tax is specifically defined, which is completely different from what you get in accounting as an operating lease. Okay, so you might get a paper. Remember, our papers are integrated. So in the integrated scenario, they might talk about an operating lease in accounting. Please do not assume that is the same as tax. An operating lease for tax purposes is defined under section 23 cap A. Okay, so an operating lease for tax purposes defined under section 23 cap A, and it so happens that section 23 cap A is out of the examinable pronouncements. Okay, but just to familiarize yourselves with it, just read that definition of what is an operating lease under section 23 cap A. And the other type of lease that you have in tax is what you refer to as a normal lease. It's not defined anywhere in the legislation. Okay, but that type of lease is, let's say I lease a house and I pay them 5,000 rands a month. Okay, that is neither an installment credit agreement or an operating lease. It is simply a normal lease. So in that instance, you're going to claim your deduction under section 11A for the payments that you are making. Okay, so please do not make the mistake of reading finance lease in accounting and thinking finance lease in tax. There is no such a thing in tax. In tax, we've got an installment credit agreement. Two things, definition in paragraph A, which talks about a buyer and a seller. Paragraph B, which talks about a lessee and a lessor. Right, now in installment credit agreements, how do we account for VAT implications? You need to account for VAT implications at the start of the transaction on the full amount. Okay, even though you're going to be making payments on a monthly basis, VAT is accounted for right at the beginning of the transaction. So for the seller, he will account for output on the full consideration that will be paid to him, and the buyer will claim input on the full consideration that they will pay at the beginning of the transaction. The complication comes through when you need to account for normal tax. Because think about it. You have accounted for VAT right at the beginning of the transaction, okay? But there are these payments that are going to come through on a monthly basis, which means in a year of assessment, there is, let's say you are the seller, there is an amount that is included as part of your gross income. Okay? And that amount that is included as part of your gross income is what? It's the amounts that you have been receiving. But the amounts that you've been receiving are inclusive of VAT, are inclusive of interest that is paid by the other party. Now, what is the amount that you then include as part of your gross income? Okay, in excluding the VAT. So what you need to do is to take what are the payments that have been received in that year in proportion to the total payments that you will receive over the term of the agreement. So if you're supposed to receive over the term of the agreement, total payments that equate to 200,000, okay, and in 1 year you receive 20,000. What you need to do is to take 20,000 divided by 200,000, multiplied by the VAT that you accounted for at the beginning of the transaction. And then that portion of the VAT is what you're going to exclude, okay, from the amount that you're including as part of your gross income. Okay, should I write it on the board? All right.
Which type of lease is this for?
Installment credit agreement. And specifically paragraph B, because paragraph A, chances are you're selling a capital asset, and so there won't be an inclusion in your gross income. But if there is an inclusion and it's paragraph A, what's most likely to happen is that, remember, for gross income, you recognize when an amount has accrued to a person, so either it accrued or it has received. So depending on how the agreement is drafted, in most installment credit agreements, what happens with paragraph A is that the person is entitled to the amount immediately. when you enter into the transaction. Okay, it's just that it accrues, sorry, not that it accrues, it accrues to that person immediately, it's just that you make payments over the term that you've agreed with that person. Okay, but in an instance where it does not accrue immediately when you enter into the transaction, but it accrues on an ongoing basis, so on a monthly basis, that is when you're going to have this type of scenario. Okay, so let's say, I'm not going to use the car. So let's say there's a machine. The machine will cost 150K. So that is the cash equivalent. Okay, so if you were to pay cash for this machine, you'll pay 150,000. But because you've entered into a lease agreement, okay, you're going to make payments over a 5-year period. And in total, so those 5 payments, so you're going to make per year. So it's a payment per year, which means you're going to make 5 payments. And those 5 payments will equate to 200,000. Okay, so that will be total payments. Okay, which means the difference between this 150 and this 200 is interest. Okay, so now in year 1, so if you take the 200 and divide it by 5, that gives you 40,000. Okay, so in year 1, in our gross income, we are supposed to have an amount of 40,000. Okay, but what would have happened is that at the start of this transaction, we would have had to account for VAT. Okay, let's assume this 150 is inclusive of VAT. Inclusive, not exclusive. Okay, so our VAT that we'll account for will be 14 over 114. Somebody with a calculator, please help. $18,000. Okay, let's assume it's 18,000 to make life easy. So we've got VAT of 18,000 included in this 150. Okay, now when this 40 comes through, we include 40 in gross income, but remember this 40 is already inclusive of VAT. So now we need to exclude the VAT. So how do you exclude the VAT? So remember what I said earlier on, you cannot simply take this 40 multiplied by 100 over 114. Because this 40 is based on the 200, it's not based on the cash equivalent. Okay, because the cash equivalent, you would have used the VAT Act to determine what is the VAT on that amount. So what you need to do to account for the VAT, okay, you're going to say the 40, so it will be then minus, this is now the VAT that I'm calculating, okay, it will be the 18,000 VAT multiplied by the payment included in that year, which is the 40,000 divided by the total payments that you receive over the term of this agreement, which is the 200,000. So somebody help, 10, is that 10%? It's 10%, I think. 40 over 200. It's 20, so that should be 3,600. Okay. So then what you're going to include is 40K minus 3,600 rands. So it's 36,400. Okay. But if you took the 40 and multiply that by 100 over 114, how much does that give you? So 40 multiplied by 100 over 114. 40? 30,500. 40,000 multiplied by 100 over 114. Guys, it went and then went quiet, but there's no answer. Oh, okay, 35. So if you take this, you get an amount of 35, okay, which you can see is not correct, okay, because VAT is only 3,600 rands. Okay, so you cannot, for your income tax, normal tax, your taxable, your gross income is not an inclusion of 35,000, but it's an inclusion of 36,400. Okay, because the VAT was not accounted for on the 200, but the VAT was accounted for on the 150, which is the cash equivalent. Okay. So similarly, to the person who's claiming input, the person who's claiming input will claim input right at the beginning of the installment credit agreement. When they're making payments and they're claiming Section 11A, they need to do exactly that. And say in 11A, instead of including 40,000 rands, I need to take out the VAT out of that 40,000 rands. Okay, and only claim a deduction of 36,400 rands. Cool. We can move on. Do you guys want a break? Stretch break? Yes? No? Okay, so I've heard yes, maybe no, so we'll make it a 5-minute comfort break. You can stretch, go to the